Yes, it's true. The trap is still set. It's really that simple. Nothing has changed enough to unwind the red flags we talked about on Saturday. And as a matter of fact, if anything, today we just got a brand new red flag. So welcome back to the Trade Brigade Midweek Show, where we'll take a look through all of the data points and we'll build a logical trade plan. My name is Matt, and if you're new here, hit the thumbs up button and subscribe. For additional resources, check out the links listed down below in the description, and stay tuned until the end of today's show. I've got 10 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So we'll kick things off tonight with a closer look at the SPY daily timescale, and we'll ask the question, what's going on here from a trend perspective? And the answer, to be quite frank, is not much. If we're thinking about trend, this is a balance range. You can clearly see this set here of equal highs and this set down here of equal lows. And what makes this slightly more convoluted is the fact that if you look further off to the left, it's actually a broadening formation with a series of higher highs and lower lows. So there is no discernible trend on the daily timescale, and I would certainly not be fond of looking for a breakout and Brigade bolt with momentum into blue sky territory. This really comes from the fact that we do have a new red flag when it comes to supporting evidence, as mentioned in the intro, and I won't keep you waiting. If we just jump on over here to the XLF, the financial sector, you can see that this as a bear flag has broken down today, and we are testing the daily 200 SMA. So even if you were to get a counter trend bounce, you could just set another lower high up against a declining 20 SMA, and it's problematic. Highs, lows, and technically this is a lower low. So losing the financials is of no help to the S&P 500, especially when we can also see that the XLK is clearly staged for a potential lower high, rejecting the overhead supply, rejecting the 50 SMA, and even closing back underneath the daily 20 SMA after opening above. We lost 143.75, and there wasn't much looking back. Yes, there's a little bit of a lower wick down here, but the combination of these heavyweight risk-on sectors deteriorating does not give me a warm and fuzzy feeling at all in the S&P 500 looking for a Brigade bolt here into blue sky territories. So what is probably more advantageous to look for is either continued consolidation up here near the highs and sideways action until there's some degree of clarity in financials and tech, or if the market attempts to break through this, I would likely favor a look above and fail and then some kind of mean reversion. If the market starts to pull back, I don't have a ton of faith that 686 is going to be the cleanest high or low. If it does start to step up, then perhaps we'll read into it if the supporting evidence changes, but I'm not looking at this as a primary outcome that needs to save the day. And the wording here that I really want you to key in on is needs to save the day. This does not need to happen here. We do not need to set a higher low. Would it be fine in terms of trying to build some sort of a constructive trend? Yeah, it would be fine. But the market doesn't need to do that, and it doesn't seem like it's ready to suggest that with the failure of financials and tech, as we know, slipping. So I'll give some credit to the buyers in the lower wick of today's session. Buyers did start to step up off of the low, off the daily 20 SMA, but I don't really see it as a huge win for a bull continuation of the move here. If anything, we're at a location where the risk-reward starts skewing to the downside rather than the upside. Right? If this is resistance up here in a balance range, not being supported by ultimately the XLF and the XLK technology, then risk reward starts to favor this. Mean reversion, fading off of resistance rather than once again looking for a Brigade bolt into blue sky territory. So if the market is going to be constructive for higher into the end of the week, you might get some kind of Brigade bolt here to get to the top of the range. Would I really be looking for a breakout through today's high into blue skies? No. And again, this is where look above and fail needs to be a part of the playbook, and we possibly have some kind of short up here at the all-time high, a quick sweep of 697.85, repair the overnight all-time high here, which was from prior to the FOMC at 699, and then come back down into range. I would just retarget 693.85. And this is a very clear and mechanical level, right, as a quick over-under for early on Thursday as well as Friday. You can clearly see the consolidation on Monday, Tuesday here, and then the consolidation underneath now today on Wednesday. So that's the top side. If the market does start to get up and over this and starts to hold, The only way I'm sort of trusting that is, once again, if the supporting evidence starts to turn around, if the Nasdaq somehow finds itself at the top end of the balance range, which doesn't seem highly probable, but if we do clear the 50 and we're just ripping to the top side, maybe there's some sort of catalyst, who knows what sort of tweet could get posted or what have you. If we get that, I'm not going to fight it, but it's not a top priority. And we've actually been talking about this quite a bit in the pre-market preps, where really the name of the game in this market context here is to manage your expectations. If you're not managing your expectations and you're just sort of emotionally saying, oh, it's a gap up, it's got to go higher, we're going to break out, it's going to be blue sky that's not working in this market, and it hasn't been working for a while. Just like down here, technically speaking, sellers should have offered a lower high underneath 686, and it didn't happen. So that trend continuation in the downward direction is not so clear, which is exactly why on the daily timescale, we're saying this is a balance range. It's made more complicated by the broadening formation. I don't really trust the market to move into blue sky territories with momentum, and instead fades near the highs makes a little bit more sense. Now, as mentioned, it's possible that 686 could offer a higher low. It might be worth trying to make a stand there, trying to see what the response is from buyers. If we do firm that up, then okay, we'll sort of play along, but for now, it's not really a top priority, and each level should be treated individually, right? What happens at this level? Okay, step by step, bar by bar, we make it to here. What happens up here? Step by step, bar by bar, look above and fail, great, fade back to the midpoint. If we move to the downside, right, is it possible that we could do this? Sure, and I know this exercise probably drives many viewers nuts, and this is not what you want to hear. You're just saying the market can do whatever it wants to do. Yes, that is exactly what I'm saying inside of this balance range. And once again, it brings me back to that point of managing expectations. If you get too attached to a directional outcome in this market, it is not going to end well. If the market does come in and do something that fails 686, I wouldn't fight this. This is also possible, right? And I would probably lean into that a little bit more so as an outcome, especially if the XLF and XLK continue to remain weak. One thing I will say for the buyers here into the close of today's Wednesday session is if we look at the intraday anchored VWAPs, we are above the entirety of the stack, and the low of the day was supportive off of the all-time high anchored VWAP. So small note there and a small win for the bulls. We could also come in with a Fibonacci from the balance range low up to the high, and you'll see that we are over technically the Fib 38.2. This is bull flag consolidation, technically speaking, but once again, based on supporting evidence, I am not going to over allocate here on the long side or just directionally try to lean into that literal direction in a more aggressive way. It just doesn't make sense. You could look no further than the market internals as well. If you're not familiar with the market internals, check out the video tutorial in the top right-hand corner. Look at the volume flows, right? Today, as we balance near the highs, volume flows are like slightly up. I suppose the only thing that you could read into here is just the fact that, okay, on a sell side pressure move like that off the open, we might have expected slightly more volume outflows. We didn't get that. I think if anything, all of this action really this week just supports the idea that this is a neutral and indecisive market. You can see in the advanced decline line, we opened negative Monday, closed slightly positive, flat on Tuesday, lower here on Wednesday to close at the zero line. This market doesn't really know what it wants to do, right? And once again, you should sort of manage your expectations in your actual trading to allow for maximum flexibility inside this balance range. You can see that the cumulative builds, it looks like, oh, look, nice bullish build here, Monday, Tuesday. Let me just remind you that cumulative builds into the close need to be above or below, in the case of negative, 5,000. And this is not even half of that. 1,800 into the close on Monday, that's really not a strong cumulative tick at all. So market internals do not suggest that we have overly aggressive buyers or overly aggressive sellers for that matter. I want to be very two-sided here and open-minded. There's just a total lack of conviction out of this market. And if you haven't been able to tell, right, it's until we get some new fundamental catalyst, some spark of something, who knows what that might be. Emergency rate cut. Oh my God, AI is imploding, right? Something. Maybe we get this emergency rate cut, and maybe we get this AI is imploding, right? Until we actually have that catalyst align with a key break in price, I think open-minded action here inside of the balance range on the S&P 500 will keep you okay. It might not keep you green, but it will prevent you from blowing up. If you get overly attached directionally, and if you blow up in this range, you will be unable to trade the day when we actually break out and or break down, right? You need to be able to make it to that period in the market when we find a little bit more stable of a trend. So with that, let's finish up the S&P with a quick look over at the market profile. And you can see the same thing here. Value is higher on Monday. Value is overlapping on Tuesday. Today it is slightly lower. If buyers were going to get involved here, you would think with an open at value area highs, all buyers need to do is pull back, stay in value, break back above, blue skies, and go. Where did value develop? Technically slightly lower. If you're not familiar with market profile, video tutorial in the top right-hand corner, the final thing I'll say about this is that ultimately today was a normal day, normal distribution, I should say, in terms of the bell curve. So what is that telling you alone, right, by itself? Forget about where we opened relative to prior value. Very balanced session. No need to get overly aggressive, pushing for a directional move here. I guess there's one more thing I'll say, which is just that this M period here was technically a spike into the close on the Tuesday session, and the market could not really find major acceptance underneath. Notice that the value area low of today is confluence with the bottom end of that little range in there. Okay, so right around in here, value area low. It's a slightly mechanical level around Tuesday's low. So you could carry that forward, going back on over to the platform. It would simply be this inflection point right here. Right, that's really, I think, the easiest way to think about this market. Technically, Tuesday's low is here, but the 693.85 is your short-term over-under. Are these buyers proven correct? And they check out and they say, okay, great, fine, let's try to move this higher. Or are those buyers underwater? And if so, do we revert all the way to the midpoint of the range, 686? Once again, I know this is not the analysis that 90% of people want to hear, but it's just the reality of the market currently. Let's go on over to the Nasdaq, which we already touched on very briefly, but here it is on the daily time scale. You can clearly see the breakdown from the balance range up here and still a possible rejection for a lower high underneath the 50 SMA. If you watch the Saturday update video, I had talked about the availability of an overshoot here of 613, but I'm willing to remain bearish if we still reject the 20 and the 50, and so far, that's exactly what happened towards the highs of today's session, and therefore, I am going to maintain a slightly more bearish bias in the Nasdaq, right? The S&P is extremely neutral. I would say the Nasdaq is neutral with a bear bias, right? Slight bear edge. Now, again, I've got to give a little bit of credit where credit is due. Take a look at this daily bar. You technically look underneath Tuesday's low at the low of today's Wednesday session, and then close back inside of Tuesday's range. If you're a stronger seller, this is not what you want to see, which is why, again, it's not worth being overly bearish here on the Nasdaq, but I do think it has a bit more of that bearish flavor, right? If you're a seller, you see this opening drive lower, you want to see a clean lower high sub 613 and continuation. We've already overshot 613. Let's just get the job done. Let's see sellers step up, offer the lower high on the hourly trend, and continue lower, and it's not happening. You can see we're tangled in the midpoint of the VWAP cluster. You can see that we still have the 50 and the 20 above us. I think that the easiest watch early on, or Thursday and the end of the week, it's not early week, it's a late week, but early Thursday, early Friday, is are we over or under 613 here? Neutral, right? If we're over the 50 SMA, rotation through the thin structure off to the left comes to the top of the range, the S&P 500 might alleviate some pressure, then we're looking for maybe momentum into blue skies. I wouldn't even say momentum. I would say grindy action towards blue skies, right, in the S&P 500, if we get this situation here. What I think seems slightly more reasonable is if the market grinds around in here and starts to drift slightly lower, it might not be the cleanest short under 613, but I would say underneath this level here, 607.25, that's where you lose this anchored VWAP off of the low. It's where you lose multiple reference points. That would be the weekly low so far for this current week. If you lose that, I would think that that's where the market accelerates all the way down to the equal low here at about 595.25. So a slightly more bear bias, as you can clearly see, the argument is for a lower high from here to here, rejecting the moving average stack, everything that we've been talking about so far. If we slap on a Fibonacci coming in from the top of this move to the bottom, you'll see that we have not recaptured the 61.8, and it is offering resistance near the 50 SMA, which is once again a good reason to be a little bit more bear biased to even just neutral, as long as we're underneath the moving average stack. If we can get above the 61.8, it dramatically increases the odds that we get the 100% retracement. Let's take it one step at a time. Let's target this first before the 100%, right? That's the top side. If we lose 613, and ultimately, if we put in this bear flag consolidation here, or descending triangle, whatever you want to call it, and then we sweep the weekly low, this week's low, that's underneath 607.25. You can see how we're back below the 38.2, leaning a little bit more into that bear thesis. What I will do is I'll just go, oh, no, we already looked at the 38.2 on the S&P 500, right? So no problem. We already know that this is above, right? And if we fall underneath 690, aka today's low, we're just back in like really the midpoint of the range where there is no clear edge buy or sell side. Let's quickly go on over to the Nasdaq side of the market internals. Again, I know it's a frustrating analysis for many. This is not what you want to hear. You want to hear up, down. Tell me with confidence which way it's going. It's not the market we're in. If we look at the market internals for the Nasdaq side, a little bit worse in terms of volume flows heading out of the Nasdaq. The advanced decline line much weaker today in trend lower zone for a portion of the morning. But the cumulative build on the tick really doesn't go anywhere. So when I look at it through this lens, I come back to that same conclusion basically where I say, yeah, there might be a small bearish edge, but for now, if we're over 613 and the close being literally at 613 doesn't really help tremendously. We're slightly lower in the after hours with app earnings, of course, and just some of the earnings overnight are dragging the market lower, right? So we're slightly lower, but we're not definitively opening like down here, and we're not definitively opening up here. If we get a gap tomorrow morning, that might help because it will give the opportunity to then look for the reaction off of the level. Or if you get a gap down, look for the reaction off of the level, right? That's a little bit more helpful, but just being right here, very neutral based on what we've just talked about. I would use it as an over under 613, and let's keep moving here. Let's go hit the NASDAQ market profile and see what's going on from this point of view. Same comments as the S&P. Here's your value on Monday. There was a really weird print in terms of volume on Monday. It was also the overnight point of control. It's at 25,120. We've made note of this. It was kind of interesting. The market did overshoot and then reclaim that level today. It's something I'm going to continue to watch. I don't know exactly how to parse this out quite yet. For now, value is above that level. Value is slightly overlapping the down with the previous day session. And once again, the normal distribution shows up here with value central in today's profile. So very neutral on an individual bias or basis, And in terms of this value area low, not quite mechanical. It is mechanical to the overnight low, but not really your Tuesday intraday low. I would continue to focus on, probably the high vol. This is it. It's just right here. That 25,120 area. Interesting shelf there, point of control, and then we did get the overshoot and reclaim intraday today. So that's the level on the NQ futures. Let's go back on over to the platform here. Let's finish up the broad market with IWM. Let's see what's happening from this point of view. This is the S&P. Let's go IWM. Perfect. A little bit more strength here. We know that this has been the case for the last couple of weeks. Lows, higher lows, respecting the daily 50 SMA. We know that this is a balance range, look below and fail. Not only targeted the top side, but we've broken out, I would say, fairly successfully so far. We have 3 trading days this week, all above in terms of closes. We closed right at it, but slightly above the 264.65 level. As long as we're above this balance range into the end of the week, this is constructive, looking for continuation up to new highs. We know that the market breadth, is broadening out, which is kind of ironic because it's in a broadening formation, which technically isn't bearish for the S&P 500, but we are seeing a big lag in the heavyweight components of the market and the dispersion in terms of what's happening under the hood. There's a great graphic where the S&P 500 has technically moved like 0%, and yet the underlying components on average are moving about 11%, right, in terms of dispersion. Let me see if I can find the graphic, and I'll paste it into the screen right about now in post. You can see that graphic here, leaving it up, and we will take it back down. And once again, this speaks to broadening out in the lighter weight components, moving quite a bit. But with the broad market heavyweight components being down, your S&P is stuck flat, right? So the Russell is a good representation of that. It is trying to move higher. It is trying to remain constructive over the 50 SMA, over the 20 SMA, breaking out of a balance range. But it's unfortunately not enough of a tailwind to overcome the headwind of the tech sector lagging and even moving lower. Let's drop it on down to the hourly time scale for the IWM. And what we can see here, let's zoom one more time, is a fairly nasty overshoot of the top end of the balance range. But once again, we close back above. So it becomes fairly difficult for me to say anything other than, okay, this is a low. We went straight up to a new higher high, right? From here to here, undoubtedly higher high. We gapped higher this morning, pulled back hard, and this is still just a higher low from here to here, right? There has been no pullback attempt yet since this very low. The market's been straight up out of the IWM. So is it reasonable that this is a higher low? Checks out to me, yes. And the next step, as said earlier, is just consolidation here should start lifting itself back up towards this high, right? This is a thin structure retracement if it were to take shape. And as long as we're over this level right here, 264.65, this would at least prevent all out headwind, oh my God, Armageddon for the S&P 500. So that's the take on the small caps. Let's quickly hit it with a Fibonacci from two perspectives, from the top to the bottom. You can see this is the Fib 61.8. The more time we spend above, the more likely it is, I should say, that we hit the 100% retracement. If we just start noodling around in the midpoint, which was here, that would be a little bit less compelling. If we come in from the open, so this day where the market rally actually took place from, to this high, this recapture of the Fib 38.2 is also the 61.8 from here to here. As long as we can maintain this low and not take that out, aka be back underneath the 61.8, I would think that we're doing okay. So this here, setting a higher low, some sequence that keeps this low protected is bullish for small caps. Let's finish this one off with a look at the anchored view apps intraday. These will be slightly more random anchors just because this does not align with what's going on in the broad market. The one that I would encourage us to focus on is this anchored view app to the low of the move here, noting that it is acting as support in today's session. That's the main focus as we bounce off of that level. Let's quickly take a look at the Russell side of the market internals and see what we have over here. Incredibly flat, a little bit more bearish under the hood today in the advanced decline line, and very neutral on the cumulative tick for the Russell. So, I think it's a lot of the same with a slightly stronger daily trend, basically is the takeaway on the rut. Let's go hit the market profile to finish the Russell and the broad market, then we'll hit the sectors and we'll sort of ramp through the final components. So over here, B-shaped profile, which is liquidation break off the highs, consolidation on the lows. BC down here are suggesting a poor low at the very bottom, so it wouldn't be unreasonable for a little sweep, come back into range. That would repair the low, put an excess at the bottom, and possibly stage that as a more firm higher low. I would prefer that the Russell could find acceptance over the value area high from today and continue to work itself in the upward direction. That would be more constructive, and that would align with, if I just go back over here, that would align with this attempt to move back up through the sort of liquidation post, if you will, of the B shape in the market profile. So over 264.65 is the clear target, right? If you are trying to remain constructive and bullish here. Let's reset this and let's take a look through our core, not core list, but rather the sectors first. Who was leading, who was losing, and where was the weight for the week? This is where it makes total sense, right? If we look at who's leading, it's materials. Materials are up over 4%. This is the lightest weight sector in the market. It's not necessarily risk off, but it's the lightest weight sector. It's not going to be enough to fuel the market to new record highs. Now, where again it gets kind of interesting is semiconductors are also up here. They're just shy of 4%. That's incredibly heavy weight, and it's also a risk-on sector. Then we get energy, lighter weight for sure, utilities, defensive, real estate, lightweight, technology, 1.69% is not the worst week in the world, industrials, communications, software, staples. This is kind of interesting, and I think that the chart structure itself tells more of the story. If you look at financials, that's clearly acting as a headwind also. Discretionary, not performing great, and healthcare also red on the week so far. But again, the main point is to probably look at the chart structure. Look at the chart of XLB. This is ramping clearly in a nice, clean uptrend into new record highs. Volume is clearly under accumulation. Your material stocks are really getting picked up here. If you look at the SMH, it's not as clean. Look at the cleanliness, or first look at the sloppiness, I should start with, on SMH, and then look at the cleanliness of the XLB. Let's do this comparison one more time. Here's the SMH, right? So yes, there's a V-shaped reversal up to the highs. Yes, this is a heavier weight risk-on component for the market, but is this a clean trend? No, and I think it's speaking to the volatility that we're seeing in the Nasdaq and the S&P. We did get gap fill reversal on the lows today. This is not a formation that I would typically say is bullish for continuation straight through this high. Typically on a move that looks like this, I would say you want to check back into a higher low, build some sort of tightening pattern, and then break and Brigade bolt higher. That's if semiconductors can perform. And as a matter of fact, there's some interesting semiconductor names that could go higher, namely the memory names that'll come up in the trade ideas. Let's go on over to energy, another chart like materials with a very clean uptrend. Unfortunately, this is once again a very lightweight sector, and it's also a little bit inflationary to see energy moving this way. If we look at utilities, it's another lightweight sector. This one's a little bit more defensive in terms of its posture even than energy, certainly more than materials, but it's breaking out of this balance in the upward direction. That's a risk-off signal. If you look at real estate, testing the top end of the range here, not the worst thing in the world. It might be an implication that rates are set to come down, but I don't know how much the market really believes that, right? So we'll see on the 10-year as we go forward in today's analysis. Let's jump on into the XLK. This is once again underneath the overhead supply, rejecting the daily 50. This is looking like a sharp opportunity for a lower high, in my view. This doesn't really look, like I said, constructive for, oh my goodness, we're here and here and breaking into blue skies. It's like, maybe never say never in this market, right? Plenty of volatility to go around, but it doesn't look like the primary thesis. If we jump on over to industrials, this is one of these charts that looks like materials, looks like energy, right? Industrials really ramping in the upward direction. I've got to give some honorable mentions to John Deere. Look at this thing just ripping straight in the upward direction. Look at something like your Caterpillar and look at something like your Cummins, which is not quite as good, but still a strong trend behind it over here. Look at your Honeywells of the world. I mean, this thing is vertical over in industrials, right? So really strong trends on industrials. This is a slightly heavier weight component of the S&P, still clocking in around roughly that 8% mark, but it's not full bore risk on like technology is. Let's keep moving. Let's take a look at the TLT, which is not a sector, but again, this is the long bond, slightly lower today, so rates just a touch higher, but from underneath the neckline of the inverted head and shoulders. We'll talk more about that momentarily. Here's XLC, a heavier weight risk on sector. This chart doesn't look maybe as bad as the XLK, but I would just sort of suggest, like, is this really any better than neutral? Is this chart suggesting any degree of confidence directionally? Not really. It's definitely not a clean uptrend. It's just a clean trend over here in the XLB. I almost have to force myself to stop looking at how clean the trend is there. You go back over to the XLC and you're just like, oh, this is not good, right? So it's a very clear picture as to what's moving well and what's accumulating in terms of volume. Speaking of volume and outlier volume, software. So much for the counter trend bounce, right? This was under record accumulation by retail, and it looks like we just got sold straight into as a lower high. So no dice on the IGV counter trend for anything more than what looks to be a 1 and maybe 2 day bounce at the high of Tuesday's session. They're immediately unwinding. I don't know that this goes out to make huge new lows. My comment on the IGV is just that I don't think we're going to be in store for another 20% drop in software. You could make an incremental lower low, something that maybe looks like that, and that's still pretty aggressive. That's 6.5%. You could still make this incremental lower low, but I think that the big capitulation, so to speak, has mostly unwound. If this is going to find a bottom, that's fine, but let it take shape. Don't just start throwing money at this thing in a stage 4 downtrend underneath the 200, the 50, and the 20, all stacked in the proper orientation for the bears. This is not bullish. Don't just go trying to find a deal in software because, oh my God, it looks cheap. This is horrible from a trend perspective, right? Let's go look at the staples. Staples, brand new record highs today. Bull flag breakout into blue skies there. Staples are D for defensive, as we know. And again, it looks like, in terms of weekly performance, this is underperforming the XLK. It's got to be bullish in the market. No, look at the cleanliness of this trend. Look at what's happening here versus look at what's happening over here. Yeah, you're up off of Monday's open, but this is like two totally different worlds between these two charts, right? So staples are still signaling risk off. Right? Staples are your flight to safety. You could see people, really getting beat up on the tech side of the trade, but everybody's going to need to go out and buy toothpaste, and everybody's going to go need to buy toilet paper, and everybody's going to go need to buy food and, shop at Walmart and such and Costco. So this is the XLP story, and it's still signaling risk off. I'll just say it one more time. So these names are moving, and they're moving well, but they don't add up to a confident look in the QQQ or the Nasdaq, for example. If you look at the XLY, another one of these charts that's just like, oh, well, I guess that's kind of disappointing after the clean trends that we've seen so far. Your neckline's completely snapped, if you want to call this a bit of a head and shoulders. Tesla's trying to hang in there. Amazon's saying, no way. This is a gap fill reversal here, where underneath on the closing basis, 118, this just looks heavy. Looks heavy with overhead supply, possibility to rotate into a daily 200 SMA test. This is not a constructive looking chart. Mag 7 ETF, right? Just when you think, oh my goodness, look, that's really impressive to have reclaimed this level. Nope, right? And now this kind of idea here, retesting the major neckline of left, head, right, some sort of distribution pattern up here. Underneath 62.65, I don't want to say sayonara because the 200 SMA is going to be right there to possibly act as a first touch savior. But for the most part, this is not a constructive look for the Mag 7s. XLF we already talked about briefly, so I won't belabor the point, but bear flag breakdown into the 200, you could bounce for a lower high, and this is just not enough to save the market, right? Ideally, this needed to set, okay, rounded bottom, hourly inverted head and shoulders, right? Brigade bolt over the top side, and then show me this. That's really what needed to happen in financials, and you're just getting destroyed. Look no further than SCHW Schwab, right, on this whole AI tax ordeal that was announced the other day, like a tax advisor from a competitor, right? So Schwab really got hurt on that one. You could look no further than a JPM, as we know, also failing its breakout level in here, just really unwinding this back in the downward direction. These are tough looking charts for financials, so just be aware that this is a headwind now, a big red flag, a new red flag for the market. Let's keep going to the XLV. This chart I think still looks great. XLV is also defensive. Just like people need toilet paper and toothpaste, people need healthcare, right? You're not going to just not go to the doctor because, oh, well, I mean, geez, I should knock on wood. Some people do, unfortunately, not go to the doctor because I guess, let's not get too deep down that rabbit hole, but typically it's seen as defensive, okay? So let's just go out to something like the weekly chart, and what I want to point out here is just the beauty of this as a cup with handle building out on the higher time frame. This opportunity there into blue sky territories is interesting. Don't take your eye off of healthcare is basically the takeaway on this chart. So that's your quick look through of the actual structure. Let's rip through the ratio chart. If you're not familiar with ratios, check out the video tutorial in the top right-hand corner on how to set it up. Let's just go through quickly. Problematic, problematic, problematic under a 50, problematic under a 50. We're striking out on the risk on quad. This is problematic as risk off, right? This is suggesting yes, defensive, right? This is suggesting yes, defensive. This gets an X. We have nothing here suggesting risk on. Industrials might be a little bit more neutral. Energy, a little bit more neutral. It's a lighter weight sector, right, as we know. But all top four quadrants, not looking great. Let's go to the A set. As we can see, under the 50, under the 50, above the 50, under the 50, under the 50, under the 50 with aggressive downtrends on the ARC, on the IWF, IWD, Russell, growth and value. The only thing that looks okay here is semiconductors versus healthcare. That's about it. Aside from that, apples to apples looks horrible sitting on the lows here. So really not a risk-on environment. It continues to be the same red flags we talked about in the weekend video. Nothing has really resolved higher. Gold ratio continues to sink, which is not good for the S&P. Continues to signal sort of a flight there. If you look at Bitcoin, it's still risk off. Sailor Shift tool still firing red, and also on the daily, right? We know that there's this big puke out, and this is looking more like a lower high as of right now. You would need to take this out if that can happen as follows, and that would be over roughly about, let's just call it 71,750. If we could get over that, maybe that starts to change the tone on Bitcoin, but for now, it is still signaling risk off in my view. This really hasn't done anything constructive. The more volatile this gets, the less likely it would be to continue to signal positive risk appetite. It is still in an uptrend over the 50, so we'll give a little bit of credit there, but not really a ton. Let's jump on into the dollar and interest rates. The dollar just kind of flat here on the lows around 96.45s. And if you take a look at interest rates down on the bottom, this is kind of what I was talking about earlier. Rates did back off of that 4.2. And I guess lower rates here maybe just are a signal that the market is not believing the labor report that we got this morning, right? Really knockout numbers on the non-farm payroll. 130,000 jobs added, forecasters for 66,000. And as we know, the Fed's going to revise down by 60,000 anyways. So, you would think that, okay, this is going to mean a much longer Fed pause, right? But the 10-year yield, should probably move higher in that situation. And yes, it trended higher intraday, but it's still rejecting 4.2, kind of signaling, hey, you're going to need to sort of like ease up a little bit on interest rates. The labor situation might be getting a little out of hand. So keep an eye on how the CPI report comes in on Friday morning at 8:30. Coffee and donuts on me up in the penthouse if you're interested in swinging by. Inverted ZT, kind of stable here, still looking at a pause for the next meeting. Of course, these odds have really been cemented. Let's go on over to the Fed Watch tool. As you can see here, 94.6% chance of a pause in the month of March, and that is compared to before the labor report this morning. We had 78.3. So really, the strong numbers there confirm that it's more likely the Fed does pause. But the 10-year rate coming down underneath that 4.2 is kind of saying, there's something fishy with that labor report, right? Here is the calendar where you could see the actual release. There's your 130, the unemployment rate ticking down. This was not a surprise to us, right? If you've been around the channel, we've been saying this for ages. Not going to be surprised to see that lower with the weekly claims coming in light. If you go look at continuing claims, continuing are also down. They are starting to ramp back up, so we're going to pay attention to this through the next cycle, but for now, doesn't really look all that bad. CPI is the next big tell. That's Friday morning at 8:30. Once again, we'll be live up in the office for the pre-market prep as we typically are. Come join us. We'll see how the market responds. Do we get hot numbers, cold numbers? How does the market start to parse this out with Warsh possibly in the pipeline as the new Fed chair? If we jump on into the earnings calendar here after the close today, AppLovin, the stock is down about 9% last I looked. Cisco reporting, I did not see where that landed, and HubSpot as well, I believe, is down also. In terms of other interesting watches to finish out the week, Coinbase on Thursday, no watch party for that. Rivian is interesting over here on Thursday after the close. Really ANET as well. These three can get bundled together, and AMAT, they always do them dirty. Why do they put them so low in the list? I don't know. Bump them to where they belong. Probably higher than Pinterest, if I had to say so myself. Moderna, interesting Friday morning, and then Camco as well. That's it on the earnings calendar. Let's take a peek back over at the platform. Let's finish up our supporting evidence. Bond ratios, really not suggesting anything new over here. Let's jump into credit spreads, still expanding a little in the upward direction. In the upward direction here, this is risk off. If they roll over in a big way and get back down to lows, then fine, alleviating some pressure, but for now, going sideways here, it's a little bit more of that risk-off signal, which aligns with the sector analysis we've done already. Let's jump into the HYG. This is also bearish. You could see the lower high divergence versus the equal high that we have here in the SPX. This is not what you want to see if you are a bull in the market looking for that confident break into blue sky territories. You would prefer to see that bonds are making an equal high here and possibly threatening the break over 81.20. It's not the case in the HYG. Let's get into total breadth. You're not going to see any problems in breadth, right? We could see this here. No problems on the moving averages. You can see no problems here in new highs versus lows. RSP out to a new high, so the market may not crash, but it's not really a momentum market where I would play into the idea of a big break into blue sky territories as long as tech is lagging. Really, it's a tale of two markets. The real economy, hard assets, industrials, building things versus software and the technology boom, which is kind of unwinding, if you will. Software, at least, certainly is. Let's take a look at the QQQE. You can see the bounce here on the equal weight NASDAQ is still underneath this area. So although the RSP, which is rightfully so, much more diversified than the QQQE, the equally weight components of the NASDAQ still don't spell relief in the trend count here. This is not even an equal high. It's a lower high just all day long inside the balance range. So problematic there. Let's jump on over to the VIX. I'd say that VIX is probably not likely to break the trend line here ahead of CPI, but once CPI is released, so Friday intraday, if you drop the trend line, that might alleviate some pressure in terms of hedging out there in the market, and then maybe there's an opportunity to move higher, but for now, it doesn't really seem like that's the case. If you look at the VVIX, no breakdown underneath this low. We're still under 103, which is a little bit more comfortable, untriggering the warning signs. And then if we come into the vol futures, there's really nothing jumping off the page on this screen. Still in contango, and believe it or not, the one-day VIX is also in a comfort zone here between about 1275 and 745. Let's quickly run through our core list of companies and see what's going on from this perspective. Just going to give this a hard reset. There we go, and jump into NVIDIA to start. This is interesting. I like the consolidation up here. We know that this isn't really a breakout market. However, the SMH doesn't look half bad. So if this is going to go, I would really keep my targets short or close, I guess is what I'm saying. 195.75 and the overnight earnings high here at 198.60. That's coming from the November 20th bar when the market's kind of broke there in a meaningful way, right? To the downside, that is. So NVIDIA's been in a slump ever since that situation. So there's the possibility of a break. You have to give some credit to this sharp V straight back higher. You could see this as an hourly bull flag. So I'm open-minded to this possibly being a suggestion, but I mean, my confidence on that is pretty darn low, noting the way that this broad market's been trading recently. Is it possible that this could be a quick scalp to the downside? Yes. You could probably also view, right, as a double top under the neckline 189 thin structure retracement, but I wouldn't really get aggressive holding shorts into or through the moving average stack in here, right? It's just not really a market where you're going to get that big follow through. It's been whiplash back and forth, right? So that's my take there on NVIDIA. Let's move on over to Apple. Apple is still just in a balance range. Not much to say about this. Hourly bull flag up here. I would be a little bit more constructive on Apple if the broad market's falling. The reason I say that is that Apple has been seen as a little bit of the defensive side of technology, right? So as the market was falling, Apple was rallying fairly aggressively out of this as a daily reversal pattern. So that worked out quite well, and we'll see if that remains the case as and if the market falls. Do we get this in Apple up to all-time highs? It's a Brigade bolt over 280.25. For now, another situation I would pay very close attention to is a look below and fail of the daily 50 that can then reclaim the bottom end of this balance range or just get back above the gap level, which is about 270.225. That is Apple. Let's keep moving over to Microsoft. Daily chart to start. This is just a classic previous support, acts as newfound resistance, and we're lower. I don't know about new shorts into the April gap closed low around 396.15, but I would not be like a raging bull down here trying to buy every share I could, looking for the market to bounce in a substantial way. I would look for more sideways down here, let it build out some structure. The daily chart is not A+, and for now, we are in a bearish configuration. Previous support acts as new resistance. In terms of hourly chart here, straight up, straight down. I think you get noise down here for a little bit. Let some structure build out. Let it offer a new clean setup. I don't see it cleanly as of right now. If we look on over to Amazon, this is another one where I would say let the structure build out now. Today, coming into today, right, this was a decent short underneath the inverted hammer low. But now that that move has played out, I think it's just sideways here. Let the structure build, and then we're either looking for this in the future or maybe even another look above and fail. That's possible. Or close the gap to the downside and then bounce into range. Right? Something along those lines is next for Amazon. I don't know about getting involved in the midpoint of this structure there now. So here's Google. Another red flag for the market, if you will. One of the leading names of the Mag 7. Omit Apple for now in terms of, let's think, I guess Apple, Google, Apple Cloud, iCloud, there we go, is technically hyperscaler worthy, but you usually think of Google when it comes to like that AI trade at least. So what was acting as a pretty decent leader, gap down on earnings, even recovered into early this week, it just is starting to fall apart and crumble a little bit. So I'm not all that thrilled on Google here losing the daily 50. I think this is going to be the next big cliff point. If you drop that, you're probably looking at the equal low here, 296, a little bit of a red flag. Let's go on over to Broadcom. I do like Broadcom, believe it or not, on the long side. I am starting to see some character changes out of Broadcom where the 20 is no longer rejecting this as cleanly. You can see we just broke right through it on Monday. We are still getting smacked off the daily 50, so I'll give some respect there. But generally speaking, if this was going to be a nasty and like gnarly situation where, oh my God, the Head and Shoulders is game over and Broadcom is going to zero, probably shouldn't have rebounded at the daily 200 as firmly as it did. And one of the reasons for this, perhaps, is just the CapEx announcement that we've been seeing from these companies. I mean, Google TPUs, Amazon, and their Trainium chips, right? Broadcom is the producer of many of those things. So with these big CapEx numbers, not shocked to see it come back over. And once again, the reclaim of this 334.50, I again, give it some respect, but starting to hammer off the level, nice intraday reversal off of it, let it balance. And if we can retake the 50, this is where the thin structure retracement gets interesting, right? It's over 354.80 into about 372.25. That would be the top side watch there. If you fail back below today's low, I would just let it drift back in here, and there's likely a short as and if. Not into the 200. I would... yikes, I guess that one's a little tough. I would let this be in here. And then if we can drop the 200 and move more meaningfully into a stage 4 downtrend ahead of earnings, maybe there's some sustained shorts headed into the number. We shall see. Metaverse, I don't like this chart one bit. I hate this little balance range in here. If we take a look on the hourly time scale, I don't think there's much to do in the midpoint. I think there is something to do when and if we get this, or when and if we get this. So that's what I'll be waiting for on Meta. Over 678.50 or under 655.65. Pair with it all the trades as a look above and fail and a look below and fail. That is the type of market we're in right now, and we will respect it for that. If we look on over at Tesla, I could envision something like this trying to build just like I could envision it back over here, and it failed. So not holding my breath on the situation, but we are getting a bounce close to the daily 200. I do still love on the very high time frame, like the weekly, right? This is still some degree of a cup with handle, if you will. It's not perfect, but it is kind of there. Undoubtedly, on the weekly, you are just building higher lows like this, trying to consolidate in this range. It's been an absolute dog on the daily chart in this balance range here. I don't love the daily close. I'm just monitoring for any potential holds over about 415.25 on Tesla. Let's jump on into JPM. We already talked about this a little bit. This is the line in the sand, no doubt about it. 307.25, inverted head and shoulders neckline. Got to support there, got to support near the daily 20 just to keep this thing somewhat alive. As we mentioned earlier, right, this to the top of the range pullback and go would have been successful, or we were thinking about it through the lens of being successful, noting that the earnings numbers were quite solid, and yet it fell apart. So got to hold this area, got to start to work back on that 318.50 for now. A little bit more neutral if we're above 307.25, but under 318.50. Let it be here. If we do this, back to the bull side. If we do this, all hope probably lost in financials. Let's jump on over to Palantir. Continuing its descent here. Classic, just like Microsoft, previous support, acting as newfound resistance. That probably goes down as the trade of the week on Tuesday. Today, not so good, but Tuesday, absolutely. For now, just a bear flag on the lows. If we can get this into the equal low, that would be acceptable. This as a Stevie Wonder is also acceptable. I would probably note maybe adding the level here for a potential arbitrary lower high right around this 139.25 area. Let's just do this real quick. Thanks for bearing with me, doing some homework on the spot. If you could get a lower high here, that keeps the pressure on. And ultimately, over time, this is like descending triangle into the lows, seeking more downside, right? If this is going to bottom out, I mean, you got a lot of work to do. You're still underneath the 200 SMA, 20s barreling down, 50s above. A lot of problems on Palantir's higher time frame charts, as we know. It could just be the time for many of these things to just cool off, drift lower, build out a new base for a couple of months, and then we revisit them when and if the time is appropriate. For now, moving along to AMD, this is very similar to NVIDIA, where this consolidation in today's session is interesting. If you're a seller, you want to see a close underneath the Tuesday low. That didn't happen. We supported over Friday's high, equal highs here, 50 SMA above, unfilled gap in between, 20 above. Little cautious of the upside. I would say about equally as confident in this as I would be on NVIDIA, right? So these two trades for semiconductors, I mean, they might fire off, but I've got two trade ideas for you that are probably more compelling in the SMH sector. So stay tuned. Robinhood, just detrimental on earnings, just rolling back into the lows here. Market maker low was around this spot as well. It doesn't look good. This is really high volume. Yeah, I mean, you could start to get capitulation down here, but like Palantir, you're in a stage 4. You've got 220 underneath the 50. No good in terms of the overarching trends of this thing. I would not go bottom fishing on this unless you're really tactical about finding some kind of, counter trend move here to close the gap. Maybe you just look for something over today's high tomorrow, over 80 to close at 85. That's possible at the gap fill. I would just look for a reversal. Let this build out a range. Let this build out just like just like Palantir. Let this build out some kind of a multi-month base, and then we revisit in the future. That's possible. But for now, just a really beat up chart. Hard to do anything on the long side. I would definitely lean into shorts on gap fill reversal. All right, 10 trade ideas. Let's start with CrowdStrike. CrowdStrike looks good here for a counter trend move only. As I look at the hourly chart, right, you could see the inverted head and shoulders here. You could also see the inside day today. If we can take out 418.10, this is thin structure. Now, post-market, this isn't faring so well, right? 412.25 by 415.30, a little spready. But remember, with all of the software names getting clobbered, even AppLovin on earnings, this is not necessarily a top priority unless we get a turnaround story there. If this wants to play nice, then fine, maybe. I will say that the cybersecurity names are doing slightly better than what we have on names like, CRM, Salesforce, out to a new 52-week low plus. So that's CRWD. It's one trade idea here, counter trend to the overarching trend, thin structure retracement over 418.10, 433.25 target. CrowdStrike done. Home Depot is a sympathy play to Lowe's. Lowe's went out in the newsletter scans from Sunday rather. So over 391 is interesting for some upside. We know that this fits the bill in terms of home builders, XHB. Let's actually go over to that right now, XHB. Really strong over here. A lot of talk about Toll Brothers, right, breaking out of this. Cup with handle on the daily timescale, earnings right around the corner. But Lowe's already made the move. Here's Lowe's. Cup handle breaking out over that 279.60, and now we just have HD. Home Depot, it's not as strong, so you are playing a weaker name, but if you believe that this theme is going to get some catch-up, there you go. Speaking of catch-up, Kraft Heinz down on earnings. Did rally back intraday, though, so we'll give a little credit. All right, these two ideas in the semiconductor space that strike me as interesting. WDC, not necessarily semiconductor, but memory-related, absolutely, right? Take a look at this inside bar here. It is just bull flag consolidation on a daily time scale that looks like this over a rising 20 SMA, really hot theme. The chart has done absolutely nothing wrong. It's just consolidating up here on the highs. If we could take out 280.15 into these equal highs and continuation, maybe we finally get the blow off top. I wouldn't say this is parabolic here on WDC. SNDK SanDisk, absolutely parabolic through there, but the one that I want to bring you next is STX, right? STX Seagate Technologies here. I love this chart for the reason that it has a look below and fail on the previous day low, closes back inside prior day's range, has not tested or failed the daily 20, and this could just simply be a range rotation. If you take out today's high tomorrow, you could look to the top of the range as a target around 451.01. Who let that penny slide? You guys know the deal. Round numbers only. There we have it. Okay, that is your STX and WDC. ARM, interesting on the short side for semiconductors. So if the SMH pulls back, I would pick on ARM, one of the weakest names in semiconductors. If this takes out the 2-day equal low, you're looking at a retracement here. Here it is on the hourly time scale. You can see that, yes, let's zoom in. It did recapture the daily 50, but this lower high, equalish lows, crack that. I'm thinking thin structure retracement here, and then the rest is gravy if it really wants to make the move to the daily 20. So you've got long and shorts for the semiconductor related names. Let's keep going with something like let's go Flex. Flex here, kind of interesting, very similar to it's testing, right? So this up and over the top side into about, what is that high in there? 72.10 gets fairly compelling on the top. And we will go ahead and drop in the nice round number. Perfect. That's Flex low cheat up and over 67.65. Let's take a look at CCL. What's going on with Carnival Cruise Lines? Looking over here, we can clearly see the nice cup with the handle and a couple of inside days over the span of this week, holding up over the breakout point at 32.70. If we could take out these inside day highs, that's where I think this thing gets going. Let's quickly grab ourselves an hourly level up here and just make sure we have the right number. I would call that at 33.50. No problem. That is the zone. All right, so something that looks like that. Continuation out of CCL. I would avoid RCL and CLH. RCL not nearly as strong, and then NCLH is like totally forgotten about. And Norwegian Cruise Lines, NCLH. No, am I crazy? NCLH. Did I type something wrong? Maybe I did. I would focus on the CCL, right? Strongest of that batch. Let's go PSTG, Pure Storage. PSTG, there we go. What do we have on this one? Nice little base down here. Possibility to break out. What makes this one compelling is the gap range overhead. Previous earnings gap left unclosed. Daily 200, daily 20, daily 50, all stacked below us. This doesn't look half bad on PSTG. Pure Storage there to the top side. GIS, General Mills, one of the laggards, excuse me, one of the laggards of the XLP consumer staples, breaking trend. It is straight into the daily 200. I have to respect that, but this is a laggard of staples. If it's going to perform, maybe it's higher. CAG Conagra as well looks very similar and is actually over the 200. So you could choose between those two, which you like. Let's go HL for Helka. On the mining front, this is fairly straightforward here, up and over potentially 24.25 as an idea. We'll see if it actually unfolds. Metals have been kind of independent of the broad market as of right now, so that's interesting. And then NFLX, Netflix, just a nice short here, potentially underneath the equal lows after a lower high at the descending to 20 SMA, with a small little range into about 77.25. If I go to a weekly chart, you can see where we're coming from. It's this breakout point that led to some pretty strong upside after a 2-week inside range. Boom. Big breakout there. So that would be the retest level on the bottom if we do get some follow through to the downside. All right. And that's what I've got for you in 10 additional ideas. I don't know if that was 10 or 11 or if it was 9, but just about 10 in today's episode of the Midweek Market Update. So if you enjoyed the video or learned anything new, let me know down below in the comments section or by giving the video a very simple thumbs up. As always, we will be live tomorrow morning and every morning for that matter up in the office at 8 o'clock Eastern time for another episode and installation of the pre-market prep. We will have coffee and donuts on Friday as we receive the CPI inflation report at 8:30. They disturbed our Friday. How dare they with that government shutdown? So with that being said, have yourself a green and fantastic trading week. Manage those expectations in the broad market. It is choppy out there. Make sure you can live to trade another day. Do not oversize your positions. Do not get married to a directional thesis. With that said, have a green trading week. And as always, I will see you in the next one.